All right, let's jump right in. We're going to break down a really fascinating piece from Barron's that shines a light on a huge opportunity in a corner of the market that's, well, usually pretty sleepy. We're talking about municipal bonds. And believe me, things are getting exciting. So let me just ask you a question straight up. What if I told you there's a high quality investment out there right now, kicking off a yield that's getting close to 8%? Yeah, in today's market, that sounds almost impossible, right? But stick with me, because the numbers here are very, very real. And there it is, 7.83%. Now, what does that number actually mean? Well, according to the experts at Baird, who were featured in Barron's, this is the tax equivalent yield. And that's for someone in the top tax bracket who buys a top-rated 30-year municipal bond today. We're going to unpack exactly what that tax equivalent part means in just a minute. But first, a super quick refresher. For a lot of people, munis are kind of the definition of a boring investment. I mean, they're stable, they're predictable, but right now they are hiding a seriously compelling twist. It's really simple. When you buy a municipal bond, or a muni for short, you're just lending money to a city or state to build stuff we all use. Think new roads, schools, airports, you name it. They pay you interest for that loan. And here is the real kicker. That interest you earn is usually completely free from federal income tax. Okay, so how do we get from a nice little tax break to this massive, unexpected opportunity? Well, it turns out a few key things have lined up perfectly to make these normally quiet investments look, frankly, irresistible. And hey, don't just take my word for it. The experts Barron's talked to put it about as bluntly as you can. They said that compared to where they've been historically, the value you're getting in longer-term munis right now is just exceptional. So what in the world is going on? Well, it really boils down to two main things. First, there was some lingering anxiety, some jitters in the market about possible tax law changes. But the much bigger story, the real headline, is a record-breaking flood of new bonds just pouring onto the market. And look, this isn't just a little wave, we're talking about a tsunami of bonds. The amount of new muni debt that came out in 2024 was a record. This year, it's on pace to be 20% higher than that. Now, money is flowing in, people are buying, but there are just so many new bonds for sale that it's pushing prices down, which in turn pushes yields up for anyone buying today. It's a classic supply and demand story. Here's another way to see just how good this value is. This chart shows you the yield on a 30-year muni bond compared to a 30-year treasury bond. Over the last 5 years, that ratio has been around 89%. Today, it's all the way up at 96%. And all you need to know is that a higher number means you're getting a much better deal. Simply put, munis are unusually cheap right now. Okay, so this is where it gets personal. Let's really dig into the math behind that tax advantage and figure out who really stands to gain the most from this pretty unique situation in the market. To do that, we have to get this one term down, tax equivalent yield. It sounds a little complex, but I promise it's not. All it does is answer one simple question. What would a regular taxable bond have to pay you to equal the take-home profit of your tax-free muni bond? The higher your tax bracket, the more powerful that tax-free part becomes. And this is where the math gets just wow. It's really compelling, especially when you look at how long the bond is for. For a 10-year bond, the value is pretty clear for anyone in a tax bracket over 25%. But then look at the 30-year bonds. Because that ratio to treasuries is so high, 96%, the experts in the article say they make sense for almost everyone. We're talking anyone paying more than 5% in federal taxes. That is a huge group of people. Okay, so we've got the why this opportunity exists. Now, let's get into the how. How are the pros actually playing this? Let's check out the strategies the Baird experts shared with Barron's. So usually, if you want to chase higher yields, you have to take on more credit risk. That just means you buy bonds from cities or states that are maybe a little less financially stable. But these experts, they're taking a totally different path. They're going after something called structure risk. They're sticking with high-quality governments, but are finding bonds with unique little quirks that pay them extra. So what on earth is structure risk? It's basically getting paid more to take on some uncertainty about when you'll get your money back. For example, maybe a bond has a feature that lets the city pay you back early. That's called call risk. Or if it's a housing bond, maybe it gets paid off faster if a bunch of people refinance their mortgages. You get a higher yield for taking on these kinds of unknowns, all without having to buy a lower quality bond. Pretty smart. And let's make this real with some actual examples from the article. The pros bought a top-rated Florida housing bond. By accepting that some homeowners might prepay their mortgages, they picked up an extra 1.1% in yield. That's huge. Or they bought a Denver airport bond that could be paid back early in 2028. For taking on that risk, they got more yield. It's a much savvier way to hunt for income.
All right, let's be real for a second. No investment is a sure thing. So before we wrap this up, it is absolutely crucial to look at this whole opportunity with a clear, balanced perspective. We got to weigh the good with the bad. So on the reward side, the case is pretty rock solid. You've got these incredible tax equivalent yields, valuations that look great compared to history, and you can find all this in high quality bonds. But the risks are just as real. With governments issuing all this new debt, there's a higher chance for credit downgrades down the line. You can't just close your eyes and buy anything. You've got to do your homework and, most importantly, build a diversified portfolio. And that brings us to the expert's final advice, which is basically a clear checklist for anyone looking at this space. You have to do your own credit research. You need to build a diversified portfolio. Don't put all your eggs in one basket. And bottom line, understand exactly what you are buying before you jump in. Which all leads back to this final question. With a record supply of bonds creating historically attractive tax-free yields in a high-quality part of the market, well, maybe it really is time to rethink this supposedly boring investment. Based on what we're seeing from Barron's, the answer seems to be a pretty loud yes.